Yeah, speed is everything. That's something we were taught pretty early on, and we were fortunate that Brandon and I both kind of have that mentality of why not today, not tomorrow. So when we would use contractors, they would try to give us a loose like 2 weeks, 3 weeks. Well,
Today, I'm talking with Justine Spillers, an attorney turned multifamily investor and co-founder of Real Estate Alpha. He's going to talk about how he turned buying $30,000 duplexes into a 600-unit portfolio with his partner. I'm going to let him tell the rest of that story, but if this is your first time on the show, go ahead and hit that subscribe button and let's hop into the conversation. Okay, Justine, thanks for being here. I remember when we were having our conversation just a few minutes ago, I was like, man, I know I've met Justine. Where was it? And just for everyone's reference, met Justine at the Best Ever conference where I saw him and his company, Real Estate Alpha. So, Justine, why don't you just hop in, introduce yourself, give us a little bit about your background and how you got to Real Estate Alpha and then what y'all are doing now.
yeah, sounds great. Appreciate it, Jared. I'm from Minster, Ohio, small town, farm country in Ohio, about an hour north of Dayton. Did all my schooling at Ohio State, both undergrad and law school. Practiced real estate law for about 7 years at a big firm. About 10 years ago, went into business for myself, started investing in real estate with my business partner, Brandon. Started small like everybody, singles, duplexes, etc. Cut our teeth on a little bit of everything, industrial, storage units, mixed use, etc. Found our footing in multifamily residential value add. And that is all we do now. We have about 600 units in Ohio. Growing the portfolio pretty quickly. We do everything in-house. So yeah, we'd love to chat more about that.
Okay, very cool, man. All right, so real estate law. What were you doing when you did that? What got you into practicing law?
Yeah, so my father-in-law owns a large refrigerated trucking company, and he always said the one thing he wished he would have done is gone to law school because he could learn everything about business, about what he did, sales, marketing, etc. But the law is the one thing you just don't learn inherently through running a business. So I took that to heart. I always wanted to own my own business. So I went to law school because he said that. I started dating his daughter, my high school sweetheart. So already had a good relationship then. Went to law school because I knew I wanted to start a business. I just didn't know in what. Did corporate and real estate law for a long time. Really liked real estate. Really liked the clients that I worked for. A lot of the bigger companies in downtown Columbus, Ohio, they got some really good real estate developers there. Very interesting to see. I like the appreciation of real estate. And really just that it was an asset. You could see it, you could touch it, nobody could take it from you. That was probably the most compelling thing. Again, father-in-law also said, find something that people always need. So he tried to get me to go into making like bread or eggs or something, but real estate, you always need paying rent, kind of tangentially similar. So chose real estate.
Okay, very cool. And so how long did you practice real estate law for?
Yeah, about 7 years. I'm still a licensed attorney in Ohio, so still do way more legal work than I'd like to, but it's nice being able to wear that hat. I don't do as much of the big heavy lift anymore, but it's nice to at least know and be dangerous in most areas of the law.
Yeah, no, that's great. I actually was having a conversation with a client who's an attorney now, and just like realizing how few people actually read the documents they sign. Probably not surprising to you at all, but also a little bit scary, right?
Yes, very much so. It's a lot though. I mean, it's overwhelming. There's a lot of words in there, a lot of provisions that you would have no idea what they mean unless you took second year contract law in law school, right? And found out what those boilerplate provisions were. They all mean something. I assure you that. And I've seen them used in very unique ways. But there is just a handful of terms that really matter. That's kind of the meat and potatoes of it. So most people at least know to look at that or have their own counsel review stuff. So it's been pretty good. I don't usually see people get tripped up too much on the legal side of things. Really, it's the deal, right? The mechanics of the deal matter much more than some of the crossing T's, dotting I's.
Yeah. Okay. So you got into real estate investing. You said you started small, probably like, and really the idea is like, a lot of our listeners are going to be newer to passive investing. Maybe they thought they should be going into single family. That was their first thought. And then they stumbled across the idea of investing with others passively. So what did that early stages of you investing smaller in single family look like? And how did that progress?
Yeah, so we started. I was still practicing attorney. And my business partner Brandon, he still had other jobs as well. So we bought our first property. Still had other active sources of income, and did
Hmm.
everything you could find in bigger pockets. Right, the burst
Oh, yep.
strategy, other people's money, seller financing, etc. Right, we tried to do everything you could to save a dollar. So we're able to buy quite a bit on the unit count size. We got up to 100 units pretty quickly.
Mm,
First 2.5 years. But it was all just through hustling, finding good deals, being able to do the value add
yeah.
process, refinance it quickly, use
Now,
the
what were
seller.
those? What was the acquisition price on those properties?
Gosh, those are the good old days. Our first, we had a 7 unit we bought for 118,000,
Oh my gosh.
and at the time I thought it was the most money I'd ever heard of in my entire life. And that 7 unit now is probably worth about $500,000. So
Okay.
and that was probably over an 8 year period. So it's just crazy. Yeah, the unit prices, you're at 15,000 a unit. You buy duplex for 30,000. I mean, those duplexes are $150,000 now.
Yeah. Were you buying all multi-door units, like, two and up? Or were you buying true single family as well?
We bought probably maybe 25 or 30 single family houses over the
Okay.
years. Tried to find multi-unit, but we kicked up good ones here or there just from our relationships. And knew we could buy right. My business partner ended up getting his real estate agent license, so he was a little bit more nimble in the MLS and being able to see things coming down the pipeline and
Yep.
try to be able to flip it for a quick buck too.
Yeah. Okay, man. Yeah. That's so. I assume with those price points, that was in your general market.
Yeah, so we're in a smaller market just north of Dayton, Ohio. Our home base is Piqua, Ohio. It's about 30 minutes north of Dayton, so that west central side of Ohio. So in all those small tertiary markets, 20, 30,000 people, towns, that's where we bought
Yeah.
most of our stuff initially.
Okay. Yeah. Those prices sound crazy to me, but I grew up in DFW. So trying to think what our per unit cost is on like a quadplex. I mean, I see quadplexes are going for 600 grand for 4 units, and that's kind of on the low end, like a reasonable price. So, yes, that's great. So you started out, you got up to, said what, 100, 120? What did you say? 120, 150?
Yeah, we were a little over 100 units pretty fast. About 2.5, 3 years in, we came across a 48 unit, able to find an out-of-state seller. They were able to carry some of the purchase price, so we got into that pretty quickly. So that really launched the unit count trajectory.
Okay, so you were buying small multifamily up to, that's medium. I mean, it's still maybe small in the grand scheme of things, but that's pretty big thinking for an individual investor or a partnership. At what point did y'all start transitioning away from that business model, and why?
Outside of real estate, we each had our own businesses. I was able to actually start a contract manufacturing company with another friend. So same shiny object syndrome, right? Chasing a couple different businesses.
Which I have. Yeah.
Yes, very tough to do. So ran a contract manufacturing business in the Amazon kind of run up. We were wholesaling, white labeling stuff, had a company in China, doing the whole shebang there, and then just dumping the passive income into real estate and doing like a 70-30 split of my time. And my business partner, Brandon, was kind of doing the same thing, but he had a construction company and a roofing company as well. So his was way more interrelated to the real estate side. So we did that kind of dual path for about 6 years, and realized the multifamily and real estate we were making more there than everywhere else. So end up selling all the other companies. Him and I went full time into real estate together. And that was really the big shift up in for the first 6 years. I think we peaked at about 300 units. We did end up buying an 84 unit. That was a pretty big one. But that was really when we knew, like, okay, let's stop with the small stuff. The big stuff matters. And then once we stopped our other business ventures too, went all in, that's when we really, okay, we are multifamily value add investors, only larger properties now, 50 to 200 units or more. We're not going to do with any of the small stuff. Don't chase the shiny object syndrome anymore. We're big Alex Hormozy guys. So the woman in the red dress is what we call it. So we don't chase that stuff anymore.
Okay. All right. So let's start back with some of the early days. If we have some listeners here who are like, okay, all that sounds great. I can't start that big. and I want to do it myself. So they're looking at the smaller units. What would you say some of the biggest lessons you learned in dealing with these, sub 20 units, maybe even really the kind of more the sub 10 units, the do's, quads, tries, stuff like that?
Yeah, speed is everything. That's something we were taught pretty early on, and we were fortunate that Brandon and I both kind of have that mentality of why not today, not tomorrow. So when we would use contractors, they would try to give us a loose like 2 weeks, 3 weeks. Well, you have 48 hours. That pulling it forward mentality really helped us, especially when you don't have a lot of capital and you're using other people's money. Like we were doing a little bit of friends and family at like 10%, like a 12-month note, things like that. So, and then we'd get like an interest only period on the loan, maybe 12 or 24 months or 18 months when you have more cash flow. Being able to do the full renovation quicker was definitely the big unlock, because then we could refinance it quicker and get all of our money back, get out from under our skis and move on to the next one. So we both kind of developed that process early on in kind of year one of, okay, let's go really, really fast. And that was just a function of education, right? Listening to the Bigger Pockets podcast, reading all the real estate books there are. And a lot of them kind of said, hey, speed is time value of money is everything, especially when you're using other people's money like we were in the early days.
Especially when 10 and 12% interest is adding up. Yeah. Okay. So speed. And then what was it like? Were you managing your own properties, or were you using a third-party property manager when you had this many units going?
Yep, that's one thing that's kind of rare. We've always self-managed. We've never had a third-party property manager. And it's mostly because we bought in our own backyards, right? The properties are all either in the same town we lived, at the town next door. So we could do it. And we were both pretty hands-on guys. It was nice. Obviously, I had the legal degree, so able to cut costs, avoid a lot of risks there on the legal side, not have to incur the attorney fees, and even the title work. I could do our own title searches, things like that, because I was part of a title exam company. And then Brandon was very hands-on, being an engineer, had a lot of experience with systems and processes. So he basically acted as the GC, doing all the work, and knew a lot. He was just super handy guy and knew a lot of the ins and outs of, okay, this is what it should cost to fix the toilet, or this is what it should cost to remodel the kitchen. And then just being scrappy, right? Buying things cheap, trying to go to Facebook Marketplace, get new appliances, just wherever we could save a buck, we'd do it on the early days.
Okay. And now, and in my head, I kind of envision this listener who, like one of my clients, a heart surgeon or a doctor, or someone like you, an attorney, either in a practice or running a practice, super busy at work, and they want to get into real estate investing in some way. What does that managing the first couple of units look like? And that's honestly, it's kind of one of the, and I'm not kind of trying to lead you in the question, but one of the reasons for a show like this is I have clients who, they think of the stock market and they think of single family real estate. And so you get a doctor who buys a single unit as an investment. And now they're a surgeon and they have a rental tenant that they're making $200 a month on. What should they be prepared for, or what level of scale do you think they need to get to for it to start making sense if they're going to be doing this themselves?
Yeah, I mean, I really like the rule of thumb of 100 units. I mean, I think that's at a good point, where you have economies of scale to do a lot of things more efficiently with your own team members. But I know if it just would have been me, I honestly don't know if I would have been able to self-manage them. Brandon is just very hands-on, and really liked that aspect probably more than I did. Not that I couldn't have. It's just a lot of work. You're always available. You're always on call. You got to know a lot about a lot about a lot of little different things. But it's at the end of the day, it's problem solving, right? I mean, it's a problem. How do I solve it? There's always a way. It's just, how do I do it more economically? I don't want to overpay. I don't want to pay somebody $250 an hour to do it. So finding a cheaper solution, asking a lot of questions of why. Somebody tells you, well, you need to replace the air handler. Well, why? Can we fix it? Can we troubleshoot it? Can we do it cheaper? What else do we have, right? What's option B? So not always taking the first option, the more expensive one, really asking the why question and learning what's behind the hood. I mean, we've gotten quotes for everything from tree removal to asbestos removal to lead paint issues where the first quote's $30,000 and we drill and get 3 quotes and it ends up being an $800 fix, right?
Yeah.
So if you always are accepting the first solution somebody gives you, you're running into a lot of problems. So understanding that you got to find 2, 3, 4 opinions, make sure it makes sense. I mean, now with ChatGPT, I mean, you got at your fingertips, right? 10 years ago, I would have killed to have ChatGPT on a lot of these issues and troubleshoot it. I remember Googling, like, what is lead-based paint disclosure requirements? Like, what even is lead-based paint? The first time someone said we had lead paint in one of our apartments, I was like, I don't even know what that is. So yeah, I'd say being willing to learn and ask the right questions was important. But that self-management or not, I mean, I've heard success stories a lot of different ways. Where we want to go, we knew we had to self-manage. We wanted to grow big. And why not do it on unit one, day one, versus paying somebody else to slowly teach us and train us? Not that you can't do that. I think if you want to keep scaling, especially if you're a doctor, lawyer, professional, having third-party management makes a lot of sense, just because you obviously don't have the time to do a lot of those smaller things. There are really good third-party property managers out there. We just decided to do it ourselves and always have.
Okay. Now, and I want to maybe transition to something else you said. Those early days, you said you were basically borrowing money from friends and family on notes, right? So let's say our listener is that guy being approached. How should that person be considering, one, who they lend money to? Because that could complicate things in a relationship. But two, what should that structure look like to protect them as that passive investor? They have their nephew, their friend's younger son, whatever. They're starting to do this stuff. They're flipping and they're coming, they're looking for private money. What structure would they want to protect themselves in these types of scenarios?
Yeah, so if you're a private lender, obviously you want a promissory note. There's a type of promissory note called a cognovate promissory note. You always want to do that. And what that means is basically the person borrowing the money gives up all their rights to contest a shortfall of a payment. So if they miss a payment for any reason, you can take that cognovate note to your local courthouse and you instantly get a judgment. They don't even get to file an answer. They already waived their right to an answer with the cognovate provisions in the note. So first, always do that, because if they miss a payment, it's automatically you can get a judgment and collect on it. That's always, in my opinion, the first thing to do. Second is a personal guarantee. If the person that wants the money is not willing to sign a personal guarantee, there's some inherent risk, right? Me and Brendan, we have always personally guaranteed every dollar of debt we've had, whether it's private or with banks, and we've had no concern doing that. We're finally at a point where we're starting to use agency to refi out and get some of the non-personal guarantee debt. But yeah, for the first 9 years, we had to do it. We had to put everything on the line. And I think that's essential. I would never lend money to someone, especially starting out, who wasn't willing to personally guarantee it. Not that that's a safeguard. I mean, I've had plenty of friends that I've seen do that, and then someone filed bankruptcy, right? And then you're kind of SOL. So cognovate note, personal guarantee, and then if you can get collateral, great. But a lot of times banks don't like having a second mortgage behind it. I personally would file a second mortgage on the property I'm lending into, even though bank obviously is going to get made whole paid first, but at least you have that second position to try to collect on it. So that would be the 1, 2, 3 I would always do. And then the bigger one is just know who you're lending it to. I mean, people give us money. They don't even know what we're buying, right? They know nothing about the 7-unit I bought in Piqua, Ohio. They trust me. They know me. It's all relationship driven. So they're lending me the money, not the deal in those instances. So it's making sure you go to people that trust you, you have a good relationship with, and just having built that rapport over a long time.
Okay. Now that makes sense. And so from there, did you transition directly to Real Estate Alpha, or I know you have, is it VSF, is it properties? Where'd you go from there? How'd you get into where you're at exactly now? I know there's a couple different brands you're operating.
Yeah. So, always invested in real estate for the last 9+ years, just slowly built the portfolio up, kind of passively in that we had other things going on. We got to about 300 units, sold out, divested out of about 200. So we went full cycle in some of the bigger ones. we're able to realize some of the values that we had in our spreadsheets just to make sure the numbers were real, right? We weren't just throwing numbers in a
Yep.
spreadsheet to make our values sound good. Took the capital and reinvested it and then started growing again. Got up to 600 units now. We still have some of our legacy properties, as we call them, some of our smaller single doubles, a couple of mixed use properties just because they cash flow pretty well. And they're better for us than selling them right now. But our sole focus is the 40, 50 unit up to 200 unit, all in Ohio. That's all we do now. So the VSF brand and moniker was kind of our property management company. That's what a lot of people know us for. We create a real estate alpha to have more of a brand when we go to do acquisitions and when we do our investment side. So the real estate alpha is kind of the forward facing name for our acquisition team to go out and try to find properties to buy, and then also for our investment structure. And then the VSF side is the name that we use for our property management company that we own in-house as well.
Gotcha. Okay. So that's more tenant facing. I think that's where I was playing on your website. That's where people can go to like look for rentals. And so real estate alpha is really why I have you here, right? That's, what kind of structure or deals are you doing? How did you how'd you go from private loans from friends and family into the larger fund syndication model? What'd that look like?
So the big thing Brandon and I decided early on is we wanted to try to maintain control of our entire portfolio. Being a real estate attorney, I was involved in a lot of real estate funds, syndications. I saw LPs have all kinds of horror stories, right? I saw what some of the GPs were doing, and I kind of knew what they were doing that I didn't really agree with on how they got paid, and they kind of nickel and dime me on the fees, and they had some unique structures. So we kind of agreed we want to own the equity in our portfolio. We want to do it the right way, conservatively. We've grown it over 9 years. We've built up a ton of equity. We've reinvested every single dollar back into the portfolio, which is also pretty rare. We had that luxury because we had the other income streams from our other businesses. So once we got out of all that and sold the other ones, and we just do real estate full time now, that was the big unlock because we started seeing our value add CapEx projects complete all the way to the end. We're able to refinance, pull a significant amount of capital back out of our properties, both to reinvest, but also to use to build up our team and our infrastructure. And then seeing the value add model work, we really just started eliminating our limited beliefs one at a time. Some of the concerns I had of why I didn't want to go into real estate full time right away. One is deal flow. I didn't know if we'd consistently be able to find these big properties with a lot of upside at the rate we are right now. The second was I didn't know how long banks would give us money for. I mean, we were younger kids, right? Once we have $7 million, $8 million, $9 million of debt, I just thought the banks would shut us off. But those two things we've overcome. I mean, lending's been no issue. We get 6, 7 term sheets on every deal now. Banks fight to lend us more money. We run out of, we have a bunch of small local banks. We max out on the lending limits and we have to move on to the next one. They only lend $3, $4, $5 million. We have some small banks where we're the biggest client for them, which is just crazy to us. And then the deal flow, we've just over 10 years, we built up a flywheel. We have a really good reputation. We see a lot of properties before they come to market. We're aggressively reaching out there. So that culmination gave us a lot of confidence in going full time into the business model and just going all in on value add multifamily real estate.
Okay. So you started out borrowing money. These weren't equity raises you were doing with your friends and family. And you're using bank loans now. So were you ever, and I say the way you structure deals now, are you doing equity raises? Are you selling existing equity? What does that look like for y'all?
Yep. So pretty much self-funded everything. So Brandon and I right now are the main principal investors for everything. We still own 100% of the parent holding company. So we started a real estate fund last year for the first time ever. We had a handful of friends and family we did private loans with as needed. Kind of got with them. What was most important to you guys? What did you want to see in a real estate fund? I got with our securities attorney and our real estate CPA and said, okay, these are the 3 things we want to do. How do we structure a fund that's unique and kind of checks all the boxes? So what our fund does It is a preferred equity fund, so our investors do get preferred equity that's in the capital stack right behind the bank. So the bank gets paid, then they get paid. That's the full alignment where we're willing to put our money where our mouth is and get paid after you. Brandon and I are the common equity holders behind the preferred equity. And then the upside for the investors, they get an equity stake in our entire portfolio. So an ownership in all 600 units. And as we grow, it all gets put into the portfolio. And the real estate fund is what's called an evergreen fund into the entire open real estate portfolio. And then the 12% upside is the fixed annual payment we pay out every year. It's not a pref, it's not accrued. We actually pay that 12% out. The second benefit we give, there's no long-term lockups. So after the first 12 months, an investor can get all or some of their money back just giving us 90 days notice, which is pretty rare in the fund world, having that liquidity option where you're not tied up to an exit event. And the last benefit is because we own all of the ownership of the parent holdco, the investors can get what's called return of capital treatment of their distributions, so ROC treatment. So if you invested $100,000 with us, hypothetically, we'd pay you $12,000 every year on December 31st. A couple things happen. One, you can elect to reinvest that for that pre-tax compounding. The 12% basically doubles your money every 6 years. That's the peg our investors are after. They want to double their money, double their net worth every 6 years by reinvesting it. But if they do want the cash when they take the 12,000, they don't pay any taxes on it, which is pretty unique. And they can do that because it's considered return of capital. They can draw down their entire capital account, all $100,000 before they pay any tax. So it's all tax deferred. So the first 8 years, we'd pay you $12,000. You'd pay zero tax on that. It's only in year 9 when you draw down that full equity account where you start paying long-term capital gains. So those are the 3 big benefits that our investors really like. It's kind of akin to a debt fund in the sense that you get that fixed payment, but there's always also the flexibility of have the return of capital treatment and also the liquidity of being able to keep it in or take it out at your election every year.
Okay. So, and preferred equity, not the first time we've heard that. So I have to ask a question on it. But I think your situation sounds significantly different. What we're seeing a lot of, and you've probably seen this, is in the multifamily space, you have guys who did big equity raises, right? And then they have agency debt. And so they might have, $3 million of a $10 million deal is equity they raised from LPs. Well, and maybe they had $2 million. I don't know. They took a 20% cut on that. So $5 million in debt. 2 is them, 3 is LPs. And now they're raising preferred equity because their deal's struggling, right? So they're trying to bring in extra cash to offset the expenses of increased interest rates, and floating debt and all that stuff. So is your preferred equity here to help you guys grow? Is it to offset, variable rate debt? Why does preferred equity work for you guys?
Yeah. So in your instances, those are usually deal specific funds, right? That's when the underlying deal is not working out well. Either interest rates aren't good, they can't hit their rent targets, etc. Ours is in the entire portfolio. So you have the entire operational cash flow backstopping it. We only give it preferred equity treatment because we want to show our investors we're fully committed. Our securities attorney actually asked me that exact question. He said, you're diluting yourself every time you buy more to the benefit of your investors. And I told him, I know that. That's the point of it. So it is different than the syndicated preferred equity sense, what's deal specific. And we're doing it because we don't need that much investor capital. So for example, we have 600 units. We're probably not going to sell any more properties. I think we're just going to do the value add, refinance, and keep them long-term. So long-term holds. We want to get to 5,000 units. Brandon and I can get there on our own, just self-financing it, using our own properties, refinancing, and growing probably in about 10 years. So we thought, okay, if we can do it in 5 years, how much capital do we need using a real estate fund example? And it's not that much money. So we're going to try to use that and take a little bit of private money through our fund and see how much quicker we can grow. Because right now, capital is our only constraint in the entire business model. And there's no reason for us to keep stalling if capital is the only issue, especially when we have the deal flow that is turning out really good so far. So, for example, the 111 units we have under contract right now, it's 2 separate properties, 63 unit, 48 unit. We need about $3 million as the down payment to close. We'll get a 70% LTV loan, put 30% down. Brandon and I are going to bring about half of that, 1.5 million cash, and we're raising the other 1.5 million in the fund. So it'll be about a 50-50 split. But those investors, not only is the money, it'll be used for the down payment, but they get an investment stake in all 711 units then. So our existing portfolio plus the 111. So they're benefited by that as well. So that's what we're raising for right now.
Okay, cool. And I mean, you're an attorney. I think you're a great person to ask this question to, and not just a syndicator. But can you briefly kind of cover maybe a little bit of the pros and cons for our listeners of maybe a property specific syndication versus the fund? And some of this is highly specific to like the deal, but maybe just some of the broad pros and cons from your perspective.
Yeah. So being able to do a portfolio specific fund is rare because you have to own all the properties, right? The issues you have with syndicators is a lot of times they syndicate the first big one and they don't own all of that property. So to do the next one, they can't marry the two together anymore. And that was very important with Brandon and I. We never wanted to give up any equity from day one and be the owners the entire time. With the fund, we are technically giving up some preferred equity now, but we still maintain 100% control of the entire portfolio. We have all voting rights and all stay in the portfolio, which that would be preventative for a lot of other groups. I'd say raising for a specific deal is a little easier for most people to understand because you are investing in that property, the underlying economics. They're really vested in how that specific property is going to do, where ours is diversified across many properties, all in Ohio. The investors we have are mostly friends and family, so they're again investing because of us more so than knowing the underlying deals, but they can't underwrite and analyze every deal we've had. They can just see our track record and rely upon that. So I like it because it's simpler. You get a lot of different assets to protect you versus just one. If that one's in a huge market and it gets saturated, like in DFW, for example, you don't really have an escape hatch, right? You're kind of stuck on that one deal and beholden to that market. Where with a full portfolio fund, you have that luxury. There are plenty of other ones out there that do it because they have built it up together. They kept the same GP structure. But early on, especially as you're starting out, syndicating a single deal is going to be way easier than doing a fund across the portfolio.
Well, and then what might a passive investor or someone looking to invest their money with someone else, what are questions they need to ask for those different types of scenarios? What maybe red flags might not be the right question right now, but what are the kind of the nuances to the difference that the investor needs to make sure they understand?
Yeah. So, I mean, obviously basic real estate, being able to read the financials they're giving you and know that it logically makes sense to you how they're making money and why it works. That's the baseline bare minimum. But to take it a step further, the track record of the operator is everything. Knowing what they've done in the past is super important because, I mean, past results are the most indicative of future results of any other measurement. So knowing what they've done, have they bought a property in that market? Have they bought this size of property? Do they know what they're going to do, et cetera, from a past track record? And then the thing that I care most about is what's their secret sauce? How do they create value? Why them versus the 100 other syndicated deals I get pitched to? That's the question I care most about is why you? What do you do different? And I think that's a very important answer for the operator to be able to give you. And they should know. That should be very readily apparent. And I think there's a ton of really good operators out there that have a great track record that can create a lot of value. But there's also a lot of new ones that, I mean, you are running the risk. You don't know what they're going to run into if they didn't underwrite a real estate tax bump. They didn't underwrite insurance premiums doubling, things like that. I mean, it's very easy to get tripped up if you don't buy right on the price point going in.
Yeah, absolutely. And so that can be a major red flag to those single property investments, right? And I guess really, and I think I might want to go back to preferred equity, right? And so just to make sure I understand it fully as well, because it's almost more like they're investing in your business as opposed to real estate, right? Now, the business is the business of real estate and it's attached to those properties. But on a preferred equity deal, I know you mentioned 12% yearly. Is that like a fixed return in the sense of, I think I read that, you said it's not preferred and it's not accrued. So they're actually getting that. But on a preferred equity investment, is there upside to that, or is that typically like the stated return is attached to just what it is?
Yeah, great question. It can be structured both ways. The way we have it structured is it is fixed at 12. So it's not more than 12, but it's not less than 12. So they can realize and they can throw it. So everybody has their own Google sheet or Excel calculator, right? You throw your numbers in, you project out what you're going to have at retirement, what your goals are,
Yes.
whatever that fixed annualized return is. We tell our investors, you can put 12% in and you can count on that. That's what they like to know. So the stock market, I tell a story. My wife had a good amount of money invested in the stock market, just in a growth mutual fund when we got married. And she never even talked to her financial advisor. And I didn't really either. And I just assumed, okay, the market did good. It's going to go up 10%. And she finally was like, I need to email this guy. It's been like 18 months. I didn't heard from him. Emailed him. Oh, you lost 12% last year. I'm like, what are you talking about? It's like the market was up. He's like, well, some of the aggressive growth stocks we picked were bad. And like, we didn't even know, right? And I'm like, okay, you're done. You're going to start investing in real estate. We're going to give you a safe 12% return. And then that was kind of the genesis of the pitch and the value, right? You're never going to hit a home run with us because you have that fixed 12%. But you're going to do the safe triple every time. You're not going to get the negative years. And that's the important part of compound growth, right? Uncle Warren Buffett, compound interest is the eighth wonder of the world. If you take 12% and compound that number turns into a big number over a decade, 15 years, et cetera. I mean, it doubles every 6 years. So that's what we're giving our investors. The other thing that's nice is that return of capital tax treatment. That can't get lost because the effective yield is actually like 15 to 19% annualized returns, depending upon your tax bracket.
Depending on your tax rate.
You get to take that cash and put it to work without paying tax on it, which is a huge deal. If you were a private lender and we gave you 12% interest, you'd pay interest income on that when we gave you the cash. Well, with us, you don't have to pay that anymore. So the couple of guys that we used to use as private lenders are now in the fund. They love it, right? They get the benefits of both worlds. They get the benefits of debt and equity by sticking with us. So that's kind of the reason why we crafted it that way.
Yeah, no, that's really interesting. And I don't think I've seen anyone offer that. So again, I haven't talked to everybody, but you are the first one I've talked to that structures their investment that way. And so that's interesting. Okay. And that all makes sense. You're getting a fixed 12% return. If you want to go to an equity deal and a single apartment deal, maybe you're targeting 18. But what we've learned in the last couple of years is that it just takes a 25%, downturn in the market that's in, and all the equity's gone. And so that's what you're looking to avoid, is you're going to get a safe return. Now on y'all's deals, do y'all do fixed debt? Do y'all do variable? Do you do short term? What's your typical hold period on the assets you have in your portfolio?
So when we sold some of the bigger properties 3 years ago, we thought we were going to get into a business model where we were going to try to buy 400 units and sell 400 units every year. So try to turn these in 18 months or less and just run that model with the same size team. We didn't want a team of 300 employees. We liked our team. We had good deal flow. And we did that. We made a lot of money, got the cash, reinvested in our 1031s. We actually did reverse improvement 1031s, which was a different interesting story. But then I had two of my good mentors said, why in the world are you selling your properties? And at that time, it's because we wanted to get more money back, right, than just to refinance. And that hit home the last 3 years because those properties are worth way more now that we sold. We should have kept. So I think we're going to be long-term holders for all of our properties. I mean, we go into it that way. We take very good care of them. Like I said, we'd like to get to 5,000 units, and then that gives us a lot more flexibility. We may sell off some of the assets that aren't as good as the others. But yeah, that's this plan right now. We're planning on holding them long term. Don't plan on selling any of the bigger properties anytime soon.
Okay.
But yeah, going into agency refi, I guess to answer your question on the debt structure, we use local banks like home farm banks. Always purchase loan, CapEx loan, 70% typically LTV on the purchase loan, CapEx loan, bringing the rest of the cash 30% down, either typically ourselves or a little bit of friends and family blended in there as well. For the first time, we're using Freddie Mac to do agency refis out. So with our small banks, we're at like a 20, 25-year AM and usually a 5-year ARM adjustable rate. We
Yep.
used to get 15-year fixed debt. That was great. Those days were over now. But with agency, the ones we quoted out, they're all 10-year fixed terms,
Okay.
which is really nice. Debt structure, 2-year interest only again. Those are super attractive. Those are 6% or less rates. Yeah, so that's kind of the plan. Buy with local banks, do the CapEx project in 2 years, refi them out with agency debt.
Okay. All right, cool. That makes sense. And one of the other things I like to ask people, and you haven't been doing a ton of syndications in the last 10 years, right? But did you say that you had invested in other syndications, like personally?
Yeah, so my business partner, Brandon, and I, we've been in a ton of masterminds, tons of different communities, been part of investments in a lot of different real estate funds and groups and properties and private land. So we've
Yep.
done the other side of the coin as well. So we know from that perspective what's worked, what's not worked. And a lot of them, I mean, they were okay, and some were really good, but some were really bad, right? And it was just kind of a mixed bag. And we saw what we didn't like, so we tried to pick and choose of the things we liked
Yep.
and didn't like about it. But we've had the luxury of not having to go the syndicated route. Being on the other side of it, I'm going to try to avoid that at all costs if I can. Not that there's anything wrong with it, but having the full fund structure gives you a lot more flexibility and control. And then the other thing, the 1031 side, the way we have it structured, we can do 1031s with all of our properties and have no issues with that. Where syndications, you have a lot of, okay, who are the LPs? Who's coming with us? Who's not? How do we structure it? How much gain can we take? We avoid all those wrinkles.
Okay. Well, so, and really what I wanted to ask you in that is, and sometimes we get the best lessons from the bad experiences, but what did you see on that side of it that you would tell our listeners who maybe they're talking to you, maybe they're talking to other people? What are some things for them to look out for as they are looking at syndicators and other people looking to raise some money?
Yeah, so this goes back to my earlier. I thought you were going to ask it after I said it. What makes? How do we create value, right?
Yeah.
What's our secret sauce? That's what I would look for, and that's what I saw. People who outsource the critical parts of what I think real estate is. Those are the people that, in my opinion, it's a little bit like gambling, right? Because you don't know who you're going to get. You don't control it. Over the last 9+ years, we've tried everything, right? We've farmed out most parts of the business. We've tried leasing agents. We've tried construction managers. We tried maintenance teams. We always kind of had the core property management in-house. But since then, and seeing other people, we've brought everything in-house.
Everything.
We don't outsource any part of our business now. We control it all start to finish. So we have a team of about 50 now. We do all acquisition in-house. We got a full-time acquisitions manager, 2 virtual team members. We hammer all 20,000 multifamily properties in Ohio. We're just in Ohio. There's plenty of deal flow in Ohio to get to 5,000 units. We know it. We don't want to leave Ohio.
Yeah.
20,000 multifamily properties, 10,000 of them we've probably underwritten already. We try to underwrite about 100 deals a month. So we're looking for needles in a haystack. Yeah. So we're high volume, outbound cold calling, direct mail, working with brokers, etc. Once we buy a property, we do our own property management in-house. So we have our own property management team. We do have our own leasing. We have our own leasing managers in-house. We do all of our own maintenance in-house. We do all of our own construction management in-house. So we own the entire business model A to Z. And what that allows us to do, and just kind of an example, out of our 600 units, when we get a move-out notice, our leasing manager posts a wellness check, goes in immediately, takes a full video of the property, gives it to our construction manager. He goes through a checklist, figures out, okay, which of our 3 turn levels are we doing? Classic plus, gold or silver, depending upon how much money we can get out in the rent increase. He's kitting and palletizing everything we need. The day the tenant moves out, they'll bring in the pallet there. Their Lowe's is shipping it there. Our team's bringing it there. Our whole crew comes in. We're working 10 to 12-hour days on the days. The painters are coming in at night. And in 7 days, we turn the entire unit. And our leasing team already has it virtually staged. Online, we're getting paid ads for leads coming in. We're doing virtual showings. We already have it pre-leased so that they move in on day 8. So we control the entire structure. All of our own team members, we give them bonuses based upon speed, performance. We track everything. KPI scoreboard. We have a culture of winning, and we've trained up everybody to follow our standards, right? We're not leaving anything to chance. If you have a third-party property manager, you have no idea who's working for them. You have no idea the level of finishes they're going to put in, what quality of parts we're putting in. We have the exact same SKU numbers in every single property and every single deal. So our guys know it. They're used to it. They're beholden to us. We pay them a fraction of the cost of what you're going to pay a contractor.
Yeah.
That's the thing I'm looking for, right? That's what makes us special. We do it all in-house. If I'm investing in another syndicator, I want to know who's their property management company, who's their construction company. Have they used them before? Do they know exactly what they're going to do? Are they going to fire them in month 6? So you're going to get that fun letter saying, hey, it didn't work out. We had to break up.
Yeah.
We're moving on to the next one. That's the type of stuff that we moved all of that unknown from the equation. And that's where you can really add a lot of value and grow quickly.
Yeah. My first syndication I invested in, they went through like 3 property management companies in the first 18 months. Yeah. So,
and that is the beauty, right? I mean, you make all your money at 3 spots. When you buy, you got to buy right. The second one is how quickly can you create that value, the speed, the velocity of cash. Does it take you 3 years to transfer the property? We're trying to do it in 12 months or less. Entire 50, 100 unit property, 12 months, we want to have that thing fully turned. So the speed that you can do it. And then on the leasing side, at renewals, you make all your money at renewals by not having to turn the unit again. Can you convince them by having such a good property management customer experience that they love it here, they do not want to leave, and they've signed a new lease? Those 3 touch points. And if it's not your people, I mean, obviously acquisition's a little bit a one-time thing, but the value added by the turning of the CapEx plan and then the leasing, the property management, customer service, if you don't control stages 2 and 3, creating that value is very tough because you're beholden to another company to create the value that you're promising your investors.
Yeah. Oh, yeah. I'm just thinking back to that deal. But that's a great lead in. And you already mentioned the deal that y'all are doing, but let's not go through it super fast. So that's how you run your deals. It sounded like you have one right now. You said, it's evergreen, but you have a couple of properties coming up. So what's going on in your business right now that our listeners might be interested in?
Just in terms of those 2 new deals?
Yeah.
Okay, so we do these a little differently now too. Again, speed, right? So we sit down. I mentioned Alex Ramosi earlier. We go to his workshop every 6 months and we go through all of our constraints. How do we do things faster? How do we break this down? The last big unlock is when we acquire new properties. How do we do it even quicker? So in these purchase agreements, we have terms that say we can go in and turn a unit. So we haven't even bought either of these deals yet. One of the properties, our team went in, we already fully turned a vacated unit to our silver standard to get photos and to start pre-leasing it 2 months before we even own it. Worst case, we don't buy it. The seller is great. He just got a free unit turned, right? But we're fully marketing this thing. The other property, we just walked it. So super critical. Me and Brandon, we walk all this one's a 63 unit. We walk all 63 units. We put eyes on it. We know exactly what we're getting into, make sure our underwriting fits exactly what our assumptions were. And same thing, we picked a unit that's vacant. We're going to come in, bring our whole team. We're going to turn it in the next week, and we're going to have all of our marketing collateral. So we're already off to the races. We gained 2 extra months of preparing to take over this property. And then as soon as we take it over day 1, we're going to change the name of the property. We're going to come with a brand new sign and lay a stake to that property, all the tenants, and let them know new management. We're changing the culture. We're going to improve it. We typically buy like C plus properties. We turn them into B plus, and we just change the culture immediately. We'll bring 10 guys. We'll clean up the entire exterior. We'll do everything to put on a show and let them know, hey, things are changing for the better. So we're working on that right now for these 2 deals. We're preparing for these 2 new acquisitions, and just how do we do it now before we even wait to taking it over? So we're trying to be reactive.
Yeah, well, that's interesting because it's not even just that you're gaining the 2 months by starting early. It's if he put a lower, if the person you're buying from put a lower quality tenant in there because he didn't want to turn the unit and he just wanted to get someone in there. Now you could be affecting yourself for 10, 12 months negatively, right? Now you've got whoever they decided to put in there. You got a unit that still needs to be turned. That's interesting.
Yeah. So good point. So also in our purchase agreements, it requires them the day they sign the PSA with us, they can only do month to month renewals. They cannot renew a lease for 12 months. So when we come in, we already have a stack of month-to-month renewals. So we're not locked into 12 months at that lower rate. So that's a great point.
Okay, that's great. Okay, now, and this might be kind of like, I don't know if it's maybe a tactical question, but those are two deals that y'all are working on right now. But as we've talked about, you're really not raising deal specific. So the offering that you have is the preferred equity and the business as a whole. So how does that impact, timelines, or I guess are there deadlines for this kind of stuff, or do you raise in chunks or for part of the year? What does that look like?
Yeah. So we've really only raised a little bit, and that's been pretty much deal specific only when we're buying properties where Brandon and I don't have the whole 100% liquid to easily do the down payment. So for this one, this is the reason we are starting to raise again to buy these two properties for the down payment. The nice thing about it being our evergreen fund is we can take the funds today, right? We don't do soft commitments and then a last round, then everybody puts their money in.
I got to hold on to my cash, but not earn anything for 3 months, that kind of thing.
Yes, we would take it today. You could send it to us. You'd start getting the 12% immediately. So we're doing immediate raise, right? So it's basically first come, first serve. We raise the amount of money we need for these deals, and then we kind of close the raise, and then we wait and see if we need to raise any more for the next ones, which I'm hoping we were generating enough value with the agency debt that we can bring into the portfolio, benefits everybody. We don't need to raise that much, but I do plan on constantly raising a little bit for the deals as we grow.
Okay, well, that's a good distinction, because I know when I hear evergreen, I oftentimes think open-ended, but you're an evergreen with openings that happen as needed. Is that right?
Exactly. And it's also different because we have that off-ramp, the 90-day notice to get out, where a lot of evergreen funds, they don't have that part. So ours is truly open and evergreen, which is pretty rare.
Yes, open and evergreen, but it's not like, someone can say, oh, those guys sound good, and then 6 months later they want to come in. You may or may not have an opportunity, a reason to take their money in 6 months. Now, maybe you would 3 months after that as you're acquiring your next property, but just so listeners don't hear, okay, well, there's zero rush, I can do it whenever I want. There's really going to be windows of time for you that make sense for you to bring in investors, and then as needed if people are exiting. Is that right?
That's exactly right.
Okay. Well, cool. Well, man, what else did I not touch on that you think our listeners would be good for them to hear or understand?
Yeah, I guess another question I've been asked, I've never been the askee, is what's the black swan event, right? What's doomsday scenario with you guys? My business partner, Brian, always used to joke, "Don't die," was his response. But no, in all seriousness, economy goes bad, what happens, right? Real estate headwinds, World War III, something major happens. The risk mitigation factors, two big ones we took. Being a real estate attorney, obviously, I'm hyper focused on this. One is the quality of property we buy in, right? The asset class. We're buying in C plus properties from the BB plus. These are recession proof in the sense that, like when COVID happened, we had 100% occupancy, right? There's nowhere else for these blue collar worker families to go, right? We're not investing in downtown high rises, A-class property. This is the property that people who can't afford a single family home, who miss their mortgage payments, come back to. And then all the existing tenants are there still too, that tenant base. So we're buying right in an asset class that's very strong in good times and in bad. That's important. And then second, from the entire portfolio perspective, we can go back to old times. Brandon and I used to run 300 units with 5 guys. Now we have a team of 50 to run 600. Push comes to shove. Not that I'd ever want to do this, but we could let go of 90% of our staff. Me and Brandon and 3 other guys could run our entire portfolio of 600 people. I'd be out signing leases, doing collections like I used to do. I know very well. But 5 of us could run it all. We could make all the payments, keep the lights on, pay the banks, pay our investors, and cash flow it and survive any doomsday or black swan event. And that's really why I feel comfortable taking other people's money. I take it very serious. We're a steward of their funds. My mom and dad invest in the fund. Like I said, I'm not going to jeopardize their retirement, not knowing I can't go out and at least hustle and run this thing with the skeleton crew. A lot of businesses don't have that luxury. And it's just a function of we're very under leveraged. We only have about 50% debt across the whole portfolio. And that is a question I've gotten and I've wanted to have a really good answer for because it's an important question.
Yeah.
What's the worst case scenario? And our worst case scenario is I'm just signing leases myself again, which isn't the end of the world.
Yeah. As long as they're cash flowing, like the valuation of the individual properties doesn't matter that much on paper, as long as they cash flow. And that's just where a lot of people got in trouble the last couple of years.
Right.
So having all of that spread across properties with fixed debt at varying intervals is going to really help offset that concern. So, well, dude, Justin, thank you for being here. What's the best way for someone to get a hold of you if they want to reach out?
realestatealpha.io is our main website for investors or acquisitions or just general outreach. I don't know if I can share my email or.
Sure. I'll put it in the description. So I'll have you send it to me. That way, people aren't driving in their car trying to write it down. And we'll have it there so they can click on it.
Yep. I'll share my email. And feel free to reach out. I mean, I'm happy to help. I'm happy to give forward. I like to tell our investors and people reach out. So I'm a real estate attorney. Happy to answer legal questions without sending you a $700 an hour bill in the mail. I don't mind doing that. It's good to chat and give it back. So happy to answer any questions and help your audience out wherever I can.
Yeah. All right. Well, one final question that I forgot to ask, and I kind of almost got to, but in the investments that you have done in the past, or from your experience as an attorney, what are some red flags that our investors should be wary of if they're considering investing passively with either a syndicator, a GP, or a fund manager?
Red flags that we haven't hit on already.
Think PPM or like paperwork red flags specifically.
Yeah, I like to be able to see things in layman's terms. So I would ask for them, okay, where's your FAQ page or where's your summary of your PPM? Because that's going to pull out information that should be in the PPM and make it more distillable. We have what's called a business plan. That's like the top FAQs for our PPM. That's in layman's terms. So like what you would ask, and then it explains it clearly. I would ask for that because a good syndicator operator should have a simplified version of the PPM where they take out the important parts into a summarized version. So I would for sure ask for that layman's terms simplified version. If they don't have it, that's a little concerning because they probably haven't done a lot of investments before. The newer ones, like a first-time goer, they don't know that you need these secondary, third options to restate things simpler. That's a big one. I would also know like what's the exit event, right? That's the thing I hate with syndications. I mean, you give up a ton of flexibility to get your cash back. Is there a backstop? Is there any end dates, or is it just open-ended in perpetuity until they decide they want to get their cash back? But as far as like straight terms go, a lot of documents are written for aspiration, right? It's just so hard because nobody assures anything, right? Targeted IRR, targeted equity multiple, right? It's just that's what I get really so tripped up on. So it goes back to what's your track record, what's your history? What did you guys actually pay out last year on your last syndication? What was the actual returns, cash on cash return? Not projected, right? Let's go backwards. And do they match up to what you're projecting here? So the specific actual documents, it's super tough, right? Because none of them, they don't handcuff anybody. They all have get out of jail free cards. They all have some clause D that says like they tried, right? So I hate that aspect of it. So that's where you're really investing in the operator. You're investing in the person, their track record, more so than anybody else. Deal, yes, it matters the market, it matters the asset class, but you're investing in that operator, right? They're making the decisions that at the end of the day are going to create value or not. So I'd feel really, really comfortable with that operator. I mean, Google's a magical thing. Now with ChatGPT, I would put them in and I would search them up. If they have other properties and deals, just throw it in. Be like, this is what my operator told me. Can you fact check all of these things? Give me references and then see what comes back and then reframe the prompt using AI and just say, is this right? I would even upload. I mean, we're at a point where you can even upload the PDFs, the spreadsheets, and just say, hey, give me the 5 red flags. I do that all the time. I do that for our stuff. I literally took our entire REO schedule and put it in and said, if you were me, how would you handle the forward 10 years to get the 5,000 units to pull the equity out we can while being conservative? And it gave me a full game plan that was spot on, right? I mean, I use Grok, but AI is
Yep.
so smart. I mean, you can throw it in there and it can read the PPM for you. You can ask it, hey, what are the 3 red flags? What should I be asking them? And it's going to spit you out questions better than even I could.
Well, the funny thing is, I promise for all our listeners, I promise I did not pay Justin for that lead into, but I do have the how to use ChatGPT for due diligence, and because he's 100% right, you can throw in the documents, the PPMs, the OMs, the subscription agreements, and man, it will just eat through a 200-page document in like 45 seconds. And then you can ask it a question, and you should always double check. That's my disclaimer is, you can't fully rely on it, but man, you can process this information so much faster. And with the right questions, you can really dive into those details. So you can check that out at the description below as well. So Justin, thank you so much for being here. I enjoyed it.
Yeah, likewise, Jared. Really appreciate it.
I want to give Justin a huge thanks for being on the show and walking us through what it looks like to take a private portfolio and grow that with control. What I really took away from this was like the value of speed. So if you're looking at, these investments and these returns and these PPMs and these syndicators, talking to them about how quickly they're able to do things is going to be a great opportunity to ask additional questions. And if this is your first time listening to the show, make sure you hit that subscribe button. And if you're looking for help doing your own due diligence, 2 things: go check out investclearly.com for verified investor reviews. And 2, go check out the link to my how to use ChatGPT for due diligence. And that is a great free resource that you can use to help you review these documents.